name is Diana Oddi, and I am the Director of Marketing, Communications, and Practice Management at Mandeville Private Client. So this financial literacy event is a very important event, as financial literacy is critical, as it equips us with the knowledge and the skills needed to make informed and effective financial decisions. And the ultimate outcome of such decisions is the creation of wealth. And for women, wealth is a means to a number of ends, whether it be leaving a legacy for the next generation, or funding a post-retirement lifestyle, or having a social impact in your community. Wealth creation is the priority. And as they say, wealth creation is the top of the house. The creation of wealth helps us to fulfill all of our life goals. And so with that, today, I will discuss with you the fundamental principles of wealth creation. So I'm just going to be sharing my screen here. Okay. So if you wanted to be successful in any endeavor in life, you must follow a three-step process. Number one, you want to identify a role model. Number two, you want to get their recipe and follow it. And number three, don't change it. And that really applies to anything in life, whether or not you want to be a successful parent or athlete or any type of professional. And so the same holds true for wealth creation. If you want to be a successful wealth creator, you too need to identify a role model, get their recipe, and follow it. So if you're thinking about wealth creation, and if you're thinking about who might the investor role models be for wealth creation, you may want to consider the likes of Warren Buffett, or perhaps some of the world's most successful financial institutions, like Canada Pension Plan, or Ontario Teachers Pension Plan, or perhaps some of the large endowment funds out of the US that manage billions of dollars. For instance, the Harvard Endowment Fund or the Yale Endowment Fund. So if you were to see how is it that these investor role models, how their portfolios are constructed, you would see that they have a combination of both public and private investments. Canada Pension Plan, public and private. Ontario Teachers Pension Plan, public and private. OMERS, again, public and private. And Yale Endowment has upwards of over 78% in privates and alternatives. So you might question, okay, so you can see a common theme here. And the common theme is that our investor role models are investing in a combination of both public and private. And if we take Yale, for an example, and see how it's fared over the long term, you will see, as an example, over 20 years, Yale has returned 9.9% versus 5.9%. So you can conclude here that incorporating privates and alternatives has a positive impact on your long-term growth potential. And so we can see that our role models all have a combination of public and private. Yet, if you were to look at the typical profile or portfolio of a typical investor, in many cases, they have a portfolio that consists of 100% public investments. So, you know, that is, so there could be a big disconnect, right? Because again, if our objective is the creation of wealth, we should look to emulate and follow the investor role models. Now, if we were, again, to refer to Warren Buffett, who is arguably the most successful investor of our time, and when it comes to investing, Warren Buffett has said, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insight, or any particular inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep your emotions from corroding that framework. So essentially, he's saying here that you need two things to become successful. You need a framework and you need discipline towards that framework. Well, I would agree and suggest that you also need access. And of course, you need all three things working for you at the same time. You can't have 1 out of 3 or 2 out of 3. You need all three working for you. And so if we're talking about Warren Buffett, again, he is a master capital allocator. And when he was asked, how he became such a master capital allocator, Warren Buffett said the following: "I am a better investor because I am a businessman, and I am a better businessman because I am an investor. Therefore, if we want to be great capital allocators, we must think and act like business owners and investors." And so, that being said, we have identified the principles of wealth creation that define how to be successful business people and investors. So if there was a formula or a recipe for wealth creation used by our investor role models to create wealth, certainly we would want to know what that formula is and apply it to our own portfolio. Well, we have determined that there is such a formula, and it's called the 5 laws of wealth creation. Now, we alluded to it in our panel discussion, but if we were to take a moment and think of some of the world's wealthiest individuals. So if you could take a moment, think of the wealthiest person you know, an investor role model, let's say, and I'm just going to describe 5 things that that person did consciously or subconsciously to create their wealth. And there are 3 rules before we start. Number 1, that person had to have created their wealth, not win it, not inherit it, and not marry into it. Okay, so the first law is that that person you're thinking of created his or her wealth by owning a few high-quality businesses. Number 2, that person created their wealth by thoroughly understanding those businesses. And 3, those few businesses are in strong long-term growth industries. And number 4, that person you're thinking of at some point, they would have used other people's money prudently, either through an investment loan or leveraging. And number 5, they held those businesses for the long run. So we can conclude that these are principles of wealth creation. And if we follow them, we too, just like our investor role models, will create wealth. Now, if we took it a little step further here, and if we, as an example, let's test a typical product like a mutual fund that many investors would purchase and as a way to create wealth. And let's see how it fares against the framework for wealth creation. So if we were to look at principle number 1, if you look at a typical mutual fund, there could be upwards of 200, 300 businesses. So if that's the case, comparing it to the 5 laws, you would see it fails on the first account. Number 2, how is it possible then for that portfolio manager to really understand 200, 300 businesses? If you ask any business owner, they would tell you that it is quite a feat really understanding their 1 or 2 businesses. And number 3, how can you be so sure that those 300 businesses are all domiciled in strong long-term growth industries? Some may be, but I mean, certainly you can't be sure that all of them are. And fourthly, how can you be confident that 200, 300 CFOs all manage leverage prudently? And 5, the typical hold period for a mutual fund is 15 or 18 months. And I can't think of any wealthy person or any investor role model that sells their business every 15 months. So if you think about it, how is it possible for that portfolio manager to understand 200 new companies every 15 months? And again, if you're not if you're not following these principles, and if you're not understanding what it is that you own, you're not investing you're speculating. And if this is an opportunity to really, ask yourself, is your advisor having the discussion with you? Has your advisor discussed investment framework with you before? Because really, if your goal is wealth creation, shouldn't the principles of wealth creation really be the first conversation that your advisor has with you? And so if we take it a step further now and continue to think of that wealthy person you were thinking of, but this time we're going to kind of shift our focus onto their wealth creating business. And let's look at the characteristics endemic in wealth creating businesses. If you were to consider that business that person that you were thinking of owns, you would see that number one, the owner and the operator are one and the same. Number two, their ownership is heavily concentrated. So that owner has a significant portion of their net worth tied up into their business. Number three, there's personal identification within the business. So what I mean by this is if you're thinking about the business, you're thinking about the business owner, they're synonymous. So Bill Gates, you're thinking of Microsoft and vice versa. So there's personal identification within the business. And number four, their management style is autocratic. So whatever, they're very hands-on, whatever he or she says goes. And if you thought about it, the likelihood of the person that you're thinking of delegating any business decision power to someone who has nothing to do with the business is very highly unlikely. And that owner that you're thinking of, they're very entrepreneurial. Each morning, that business owner, she's thinking growth. At night, her last thought is growth. And all the time in between is all growth. She has a growth mindset. And there's very low turnover in management positions. That team that she's had with her has been with her since the beginning. They have a shared vision, a shared focus, and they're all moving in the same direction. And there's a symmetrical risk and reward because they all have skin in the game. If they make a very good business decision, their net worth naturally will go up. But if they make a bad investment decision, their net worth will go down. And if they make a really detrimental business decision, they could really lose everything. So surely this team, they're highly motivated to only make the very best decisions for the business. And the business, their goals are long-term and they have a growth mindset. And lastly, the value of the business is based on the true fundamentals, sales, market share, margins. So these here are the characteristics associated with wealth creating businesses. So essentially, if anyone presents an investment opportunity to you, this framework, you base the merits of that investment opportunity against this framework. If it gets 15 out of 15 checkboxes, then you can take a closer look and potentially invest. If it doesn't, you simply do not invest. So you can see the importance of investment framework in terms of making sound investment decisions. And if we proceed here, again, if we're talking about what is required to be successful at investing, yes, we've talked about framework, but again, you also need control of emotions and access, and you need all three working for you. And so control of emotion is absolutely just as important. And especially, we can see, especially what's happened over the last year. When there's a crisis, how do we feel? We often feel nervous, we feel stressed, right? But we also must remember that in every crisis, there is opportunity. In fact, there's a Chinese adage that says crisis equals danger plus opportunity. So we must remember that to look for the opportunities in terms of crisis. And a few of some sound quotes from our investor role models on the importance of control of emotion. We have Warren Buffett again, be fearful when others are greedy, and greedy when others are fearful. And Winston Churchill, never let a good crisis go to waste. And again, Warren Buffett, he always makes sure to tell us that investing is simple, but it is not easy. It's really not easy, especially when we're experiencing significant volatility in the market, to feel motivated. And but it's very important that when those times occur, that we pull out our framework and we remember the importance of framework in the control of one's emotions. Its framework is so important. And of course, we need access. And as we mentioned in the last panel, we really want to ensure that we have access. We have access to an investment framework. We want to make sure that we're asking those right questions of our advisor. We want to understand that, that there is some sort of investment principles or that are guiding our investment decisions. And we want to ensure that we have access to quality public, private, and alternative investment opportunities, typically reserved for only the world's wealthiest and institutional investors. So we want to make sure that we have access to those same investment opportunities so we can emulate our investor role models. And of course, you want to ensure that you have access to qualified investment professionals. So again, if our goal is wealth creation, doesn't it make sense that we emulate our role models of wealth creation? And with that being said, I'm going to see whether or not we can pull up, moderator, can you perhaps pull on some of the polls, some of the questions, perhaps question number 1?
Sure, 1 second, please. The poll is now live on Huba. Okay, so the question is, has your advisor discussed an investment framework with you before? And we are waiting for the answers to come in.
Great.
Okay, so 18 people have responded yes, and 30 people have responded no, and the rest did not participate.
Okay, so again, this just highlights the point, right? I mean, if you're truly desirous of creating wealth, you should really ask, shouldn't the investment principles be the first conversation your advisor has with you? You really need to understand how your advisor is really going about making those investment decisions. You have to understand that they're applying a framework to make those investment decisions. Can we go on to maybe perhaps question number 3? Poll question 3.
Okay, question number 3 is now live. Question is, do you have private and alternative investments in your portfolio? And I will read out responses as soon as they come in. Okay, so 1 person has responded yes, 20 people have responded no, and 24 have said not sure.
Okay, so this is just something to highlight. We started the presentation by saying, if you want to be successful at any endeavor, right, you need to identify a role model, get their recipe, and follow suit. So of course, if we're all intending to create wealth, which we know is absolutely essential, in order to achieve all of our life's goals, then we really need to do our best to see if we can emulate those investor role models. And as we've seen before, our investor role models are including privates and alternatives in their portfolio. So you really want to ensure that you're having those conversations with your advisor, and perhaps to Akil's point in the last panel, align yourself with a firm that can provide you with access to, those types of investment opportunities. Because as we talked about earlier as well, women are living longer, and perhaps because they're leaving the workforce for extended periods of time to help with family. Oftentimes, if that's the case, we really need to ensure that your wealth is working for you and that you're positioning your portfolio for optimal wealth creation. And perhaps the inclusion, if possible, of some privates and alternatives, that can certainly help you to optimize some of your long-term growth potential. And moderator, how much time do we have? Do we have time for one more question? One more poll question?
No, Diana, I'm so sorry your time is finished.
Okay.
But thank you so much.
Thank you very much. So happy to be here. Thank you.
Thank you, Diana.